correlation's getting slammed. It typically happens into earnings season anyway, but the way this year has played out has been a very rotational kind of year, right? So start of the year, everyone was like China reopening, chasing cyclicals, tech, knowing, it wasn't really about tech. And then that flip happened where sell the banks, get me out of the financials. I want tech because they were pricing in rate cuts. And now you've had a cyclicals versus defensives move recently where they're chasing cyclicals higher and they're dumping all the defensives, which they had bought earlier because they were scared of recession. So it's been very much a rotational sort of theme. And that's quite common when interest rate volatility is high. You get a lot of dispersion in markets. So I noticed that back when I was in the banks in 2016, I was sitting next to some of the dispersion traders and they were making out like bandits. And they did particularly well when interest rate vol was high. Because when interest rate vol is high, it impacts different sectors of the market quite dramatically. Some go down, some go up, but the net, the index itself doesn't need to do a lot because it's rates that are moving, right? So I think there's been some of that has been a part to play in the kind of index vol going down, correlation going down. Now that the skew I thought was to do with the fact that people just aren't invested enough, and so they don't need protection, right? So if you don't own a load of exposure to the market because you don't like the market because you think the economy is going to turn, why are you buying loads of put protection, right? So now that may have been turning a little bit, but the skew generally in January when people started putting money back to work, like we saw skew really flat at the back end of last year. But when people started putting money back to work in the market early this year with a fresh book, they were bidding up skew as well because they needed to buy the market and buy protection with it. That's all gone away after the banking crisis thing happened. People de-risked again and said, well, we don't need protection anymore. And so it looked like they needed protection to the upside as the tech stocks started screaming higher. And you saw that call skew go bid and put skew come down because they just didn't need it anymore. But if that open interest is that massive on the put side, then that suggests that not only have they not needed to buy puts, but they've started selling puts to fund the calls that they're long, but it still probably is against an underweight in equity. So what they're saying is, well, we're underweight stocks, but if stocks go down 10% from here, we'll sell that 10% put strike and we'll take delivery of the stock because we don't mind getting long the market again down there, right? So I think maybe that's what's been going on.